right, so welcome everybody. So I think we are back to our macro discussion. A lot of interesting stuff is happening. So let's talk about that. I think we had a few comments about various markets before we started recording here. So feel free to ask questions. I think I don't want to keep it too long because we are talking very often nowadays. Like we had a great Investor Day event last Sunday, and I think we are having another one this Sunday on the options workshop follow-up. I'm actually glad a lot of people are learning options, to be frank. So willing to continue this if is interesting for people. But basic idea here is we are trying to define, what works for the community. So it was mostly bottom-up driven, kind of initiative right now. So feel free to ask questions, and I think glad to see that we are learning together. So today, I think just quickly get going on the markets and go to share the screen, and we always look at the charts. So let me talk about that. So S&P 500 is what we track as a benchmark. And if you see here, it's mostly it's recovered most of the, I would say we are very close to all-time high, which is interesting given the background we come from, this uncertainty we were talking about. And I think if you remember when we talked earlier in April and so on, it was not looking like we will be here. But that's exactly what I think we had been talking about. That worst was behind us and we had taken support. So the good news here, though, is if you look at the chart, that we are trading above 200 moving average mostly. And we have formed this kind of a upward trend line. And we are like within, I would say, a couple of good days away from all-time highs. Um, what is the reason? I think we all know that what happened is this we were never expecting this tariff to stick, which market realized. Second part is that we were always highlighting that the tax bill will create excitement. And when I say excitement for, of course, we can always debate the merit of whether the tax bill is good or bad. But this is what everybody was expecting when Trump got elected. So we can talk about those things, I think, but let's quickly continue looking at like, yes, there is a lot of optimism. And from a macro perspective, there's a lot of pessimism because, you're talking about there is no real change in the direction, which was actually a threat for the risk assets. Means when you're talking about Doge or actual spending cuts, those are risky for the market because that can lead to recession. So I think those fears have gone away and markets are going well. And in the process, we did talk, I think, through the last month, how the earnings came out great, how everything is falling in place. Now, what is the question? The question is, yes, we are kind of getting tired in this rally. If you see, this is a trend line which is kind of forming, which maybe threaten. And if you see some of the leading indicators, like we talk about liquidity, which drives the market. I think Bitcoin was the first one to turn around even before SPX formed this kind of a channel. And what we are seeing is, as a indicator, I would say it has broken down. So because what we are doing, we saw a very good breakout in middle of April. We did very good recovery all the way to all-time highs. And this upward-facing channel, Bitcoin is breaking down. We are seeing gold kind of getting tired. So we are seeing the asset classes which were mostly leading in some of these rallies and attracting a lot of capital. So the liquidity was getting absorbed into stocks as well as these assets. We are seeing some tiredness there, some corrections. And I think SPX is just barely above this trend line, but definitely we will watch out for how the 200-day moving average test goes. So that's what is very, very basic analysis on the levels to watch out for and where we think we see the market. And as we have been discussing in the WhatsApp group also, I think the biggest concern on the macro level is we did talk about how this whole 10-year yields are a benchmark for where the bond market is thinking. So specifically today, we saw a pretty good PCE print. This was in a normal world, like if you talk about last year, this would have been a great news because ultimately this is what was driving the rate cut cycle, that the inflation is cooling down and all that. But in an uncertain world with the expectation of tariffs, expectation of things going, inflation peaking again, this did not make a much difference. And to top it all, today also was a headline about U.S.-China trade wars. If you look at any news, like I will, issues with Wall Street Journal or so on, and it seems the thing is falling apart because of rare earth discussions and so on. But coming back to this, basically, while this is great data at a macro level, that PCE, which is the core expenditure index, which is coming down, I would say this is not really being paid much attention. The reason being the Fed is not going to care about it. And the rate cut expectations are still not there in any near future. Like we are not expecting. It seems the probability of a June rate cut is still very low. And again, the reason is uncertainty, which Fed has very clearly said and Powell has already said. But definitely it has helped the yields. And we did see some concern in, I would say, a week ago when yields were going up at 4.6%. Those are now coming down, settling well below 4.5. As I keep repeating, 4.5 is where you start getting worried, and 4.7 and 4.8 is where you start panicking. That's how the market does in recent times. So I would say we are moving away from the danger zones, which is a good sign. Probably PC helped, but I think we were already seeing some cooling down. And we have also been talking about how this is, I think if you were part of our investor day, we talked about how Besant has so many other tools and to control this. So I think we will keep watching how they do it, because there was some, by the way, why did we go up here? Because of the failed, we should not say failed, but it's a like lukewarm auction of, long-term bonds. And also there was concern around Japanese 40-year bond, which came in between. We saw some concerns around yen carry trade also in the April-May time period, which is kind of uh, becoming little less of a concern as we saw that the 40-year bond auction went through all right in Japan, and US auctions have got on track again. So overall, good news. While technically, summary is that we are seeing some of these assets breaking down, like Bitcoin is kind of looking for correction. Gold is looking tired. SPX is barely managing to stick around on its trend line, and probably looking for direction here. So this is where the status of the markets are. What will drive it? Okay, so what is the question can be, okay, what will drive next? I think we had a one big indicator, which was NVDA earning, which came earlier this week. So we can talk a little bit about that. That means China impact was, of course, very well known. So the margins were lower. And but I think overall market was positively surprised. And since then, of course, it's corrected because um, the concerns are still valid, because it did go all the way to 143 with the earnings being great. And what we say great is that while absorbing a big hit of 4.5 billion, I think that's what they recorded instead of 5.5, which they had guided. They still grew quarter on quarter. They still did very healthy growth rates. And I think it's more about that AI trends are still up. So you're seeing other stocks like Meta or Google, which have been doing great. Like if you see Google has been doing very good since it formed bottom. You will see some other tech stocks like Apple has been probably the laggard, because it has been mostly the biggest company which is hurting because of tariff news every day. The reason being obvious that they cannot just move their supply chain so fast, and every time there is a negative news on China, US, this will be the impact. So I think we are again back to uncertain environment, especially today where we saw that US China is kind of falling apart. And we are on critical, I would say we have already ran up too much. So it's not an easy market anymore the way it was. I know means some people would not like it when I say it was easy, but we have been telling all access subscribers that it was an easy time. We were taking positions because once market panics, this is the time to buy. We don't have that anymore, so it's tough. So this is what actually we are also discussing in our options workshop. When you're uncertain, you cannot just blindly buy. You have to make plans. So that's the kind of market we are in, especially given that we are very close to all-time highs. So I would love to take questions and what people are thinking in the community at this point. So you can put the question in chat, or you can just speak after unmuting yourself. Please don't say your name if you don't want to, because just a disclosure for some of the new people who are here in the call. So we will be putting this recording in a public domain. So you don't have to say your name. You can ask question, or you can type it in the chat.
From the bond market, what are apart from the yield rate, what things to watch out for? And do you expect a lot of uncertainty in bond market with the Japan and US Treasury?
Yeah, so I think as I just said, it's the same thing. I would say definitely it's concerned because we are seeing Japanese bond yield going up every day. Um, and what is happening there is that Japan, I think what people don't understand is that Japan is one of the biggest provider of liquidity and capital in the world markets. There, as we say, right, means the Japan is the biggest exporter of capital. Like you should not think of what does Japan exports is not cars or whatever. That of course they do those, but I'm talking about the amount of capital they export because of the low interest rates there versus the rest of the world. So this has become a multi-decade trade. So Japanese yield going up is a concern for the markets. Um, every time though that concern shows up, there is basically it's being fully managed. Like they are controlling the yield very carefully because Japan is a favorable country to US. They work very much in a lockstep with Fed, and they are managing these yields on a very regular basis. So I would say yes, we should look out for how bad that gets because they are not raising rates even though their yields are very high. Their inflation is rising. So there is some stress in the Japanese side. But on the other hand, US markets, I think we discussed also in our last investor day also that there is a lot of tools. And again, we should look at Japan, right? Means the situation with US is in terms of the size of debt versus GDP and so on. Japan was there like decades ago, and they have been still able to managing like how to control. They can keep issuing themselves. So we and US also has the ability to print dollars, which Japan did not have. So I think it's a long answer for that, but I would say yes, it's concerning at a long-term level, but short-term level, market may react to auction like we did last week when we had an auction failure. And when I say failure, it's not like they always have a last resort buyers. Like the banks always buy up. They can always Fed can buy, and Fed gives you free capital. Like if you buy these bonds, if the bank like Chase or Bank of America and all, they can buy these bonds as a buyer of last resort. They can put that money with Fed. Fed pays them, the whole interest and everything. They can collateralize it. There's a lot of mechanism in place where you will not worry about actual failure. But what it means is, yes, the fiscal responsibility is missing for a very long time. So this is why you keep hearing about the debt is rising, and every government comes in, they promise things, but they do the opposite. They keep printing money and they keep increasing the overall debt size. So, but having said that, we believe that that only helps risk assets because you are basically increasing the money supply all the time, and that only gets deployed in this risk assets. So now we can call it a pretty much a big Ponzi scheme, which is running when you talk about US dollars. And the ability or the superpower status of US keeps this Ponzi running. So that's where we are today. So nobody can say like ideally, fundamentally, 15 years ago, 20 years ago, US should have imploded. But since 2008, and that really happened in 2008, and they managed to come out of it by simply printing. And theoretically, you can keep running that forever, and Japan has shown us that. So that's the theory right now.
So can you comment on Jamie Dimon's thing crack in the bond market today?
I think Jamie Dimon has been critical of this for a long time and for right reasons. It's and if you see, forget about Jamie Dimon. If you listen to Ray Dalio and others, they have been shouting from rooftop for years now. So I don't have anything further to add. Means everybody understands what's the problem, right? The problem is that we are missing bond buyers. Means, and the reason being, if you just keep increasing supply, where will you get the buyers? Especially when we are going to non-globalized world where people are moving away from dollars. Like China is not buying or increasing anymore. Means they are letting it expire. They are actually reducing. And I think everything else is going to be difficult. So I do have my own theories on where this debt will be absorbed. But I think that will take a long time to explain in this short call. And this can be actually a very good discussion on a like much longer format. But basic idea here is that those things are whatever Jamie Dimon is saying is correct, whatever Ray Dalio is saying is correct, but that has been correct for last 20, 25 years. So it's not like we are not in exponential phase. Means we are just increasing the curve all the time, and we are right now expected to grow the debt at 7% per year. And as you know, right, the compounding works very fast. But the question to ask is why 37 trillion is big, and why it is not already big, and what would change when it becomes 60 trillion or 100 trillion? As numbers keep going up, everything becomes more expensive, and you just have more money supply in the world. And the reason being there is nothing else. Like money, that's a fun part of what is the definition of money, right? Means things become like you just add another zero in the end, everything will work exactly same. So the problem happens is people who are not able to keep up with this money supply. So this is what we keep talking about. You should not look at how your capital is growing in absolute numbers. You should look at as a percentage of where the world's asset or world's market cap is going. This is why I think a lot of people compare how their investments are doing versus indices versus gold, and this is why benchmarks are created. So I would say just the absolute numbers keep going up. The implication you should understand is whether you are doing better than the index, whether you're doing better than the average market. That's how one can think about. And the unfortunate thing is that we are talking about people like us, who are talking about investments. We have the capital to deploy, and we can try to beat the market. Now it's getting even worse for people who don't have any money, who are starting out in their life, or who did not carry money from previous generations. And that's where I think all these big leaders are, when they're talking against it, they are worried about the inequality continuing to increase because of this. Like, you can always invest and continue growing at the scale of the money supply. Asset owners, the existing people who already have money, but the people who don't have anything, they have no other way. And that is where I think the biggest, at a society level, the biggest risk exists in this modern economics of continuous money printing and non-responsible behavior, which our governments have taken for last 20 years.
Yeah, but we read this back in our economics clerks back in the schools and colleges. You increase the money supply, you increase inflation. So I mean, the more bonds they have to issue, then you can't issue bond at 2% and stuff like that. So which means the interest rate will remain high. That also, based on what you're explaining,
Yeah.
the interest rate will remain high. The inflation, they cannot bring it back to 2%. I think that's what he's implying, and I think you're saying the same thing in different words. Am I wrong?
Yeah. No, I think what he's saying is, I think maybe we can definitely go into those. So what he's saying is, of course, the debt market is in bad shape. So the implication is we are not going to go into a deflationary cycle, because what is happening is when you are actually creating more and more deficit, you are creating more and more money supply, and that automatically means higher inflation in medium to long term. It usually has a lag factor, but it happens. So that is what he's referring to. So interest rates definitely are not going back to those 2 or 3%, which used to be like long-term interest rates. So mortgages are not coming cheaper. Inflation will remain high, so the cost of living will be higher. So yes, all these things are correct, the implications, but that also means the asset prices will go up. So there's always, of course, market will correct on some triggers and some bad news once, but ultimately what it means is money supply has to be invested somewhere. So as an investor, so let's focus on what can we do. We can always talk about theoretical things. I mean, Jamie Dimon has the luxury of doing that because he's one of the topmost money managers in the world, and what he does in his job is different from what he speaks about in forums, because he can talk about all the good things and what is the right things to do. But his bank which is gaining the most out of this. They get the best deals. They get, when the banks failed in 2023, Chase was buying all kind of this failed bank at discounted, their assets at a discounted prices. So all these people are part of the problem. So let's not get there. My point here is, as an investor, what we can do is we can understand and define our investment strategies. Means we cannot fix these things. I don't want to go into theoretical anymore. Let's take, means we have a short call today. So let's talk about investment and let's talk about what it means. So my take on this is, yes, there will be bad news on bonds sometimes. They have ability to manage. We are seeing the yields are not going up continuously. They are correcting. So market is hopeful that these things can be managed. Japan is showing us that this can be managed for like decades. So there are tools, which they can use. What does that mean is that, yes, interest rates will remain high. That is one factor which we can deduce from it, that we are not going back to low interest rates. We can also deduce that risk assets will keep going up. So that's why we are sitting very close to all-time highs on S&P 500, because as soon as the uncertainty was a little bit reduced, everybody was just waiting to buy those stocks because you have the money, you have to deploy it. You cannot just be sitting in cash and let that, like as we say, right, money rot away. Like if you're not beating the growth rate of money supply, you are getting poorer every day. So that's why they keep coming back to risk assets. That's why we are seeing all these asset prices booming. So that's what we can learn from it as an investor. We cannot go into more than that, I would say, at this moment. All right. So any other question? I think, but I think these are good discussions, to be frank, like when we talk about, so just to summarize, so what do you need to watch out for? Market will react negatively if the 10-year yields start breaking out above 4.6 or 4.7, which has been the recent tops. As we remain below 4.5, market won't bother because that's what has been already priced in, that we will remain at high prices. 4.5 is a decent premium over the short-term rates, which are 4.25. And it's not big enough premium. Usually the premium of 10-year or 20-year has been 2%. So what we are also saying is if long-term can stay at 4.5 or even 5, below 5, that means you have hope of short-term rates coming down to 3% based on historic data. So that means we have probably another 4 or 5 cuts, which can happen in the current economy if the market goes bad, if unemployment rises, if recession starts. So this is where I think another deduction we can make, that why markets are comfortable right now. And we started talking about PCE today. So the inflation, other than the uncertainty, other than the so-called belief of people that tariffs will create inflation, and I've been always questioning that, means tariffs are already applicable right now, if you see. Even the last month when tariff came into effect, yeah, you can always talk about, unknown things like people have been hoarding it, people have been managing it somehow. What I'm trying to highlight is it is more about the actual hard data, which is showing these things are coming down. And one more thing I would say, which people discount, you have to understand that internet and this whole technology, the cloud and everything, means we discount the fact that technology is deflationary while we have this inflationary forces. Now, when we talk about AI, you listen to some other leaders, not like Jamie Dimon. If you talk to other leaders like, the AI leaders, when you talk about Jensen or Elon Musk or, people from Google and so on, I mean, they talk about how there will be abundance because of AI. And what that means is the prices will come down, the services will become cheaper. So will be a push and pull, which we cannot, at a macro level, you cannot go and speculate. What I'm trying to highlight here is that it is, yes, there are bad things about what is happening with money supply and debt market, but there are good things happening also in AI side. And we have been riding this as investors. We are riding AI wave, so we can focus on those things. We can focus on how. By the way, one more thing which is happening for the debt market, which is good, is you should look at stablecoin market, the crypto stablecoin market. Today, while China is selling, there's Tether, which is a stable coin, which buys, and as they create more and more supply of stable coin, they are buying US debt. As the Circle, which is going IPO now, they have this USDC stable coin. The money supply of that is increasing every day, and they are buying US debt. So there are more new kind of fiscal or financial solutions are coming in the market, which will probably solve some of these issues. And if the growth of stablecoins remain at the rate where they are, nobody would bother about China being a buyer of debt. So there are a lot of other things which we can talk about on the debt side. Let me take a quick question in the chat. What are the critical events to watch? It's a good question, actually. So what are the critical events to watch for the next 1 or 2 weeks? I would say critical events are almost happening every week when we look at any kind of bond auctions. But I think mostly market is reacting today to the tariff news. And of course, the tax bill which passed the House, it is facing issues in Senate. So there are a lot of things which can move, I would say. If there is any resolution in Senate and if we see that the tax cut goes through, that would be a pretty huge positive news for market, because that pumps all the new liquidity and the benefits of lower tax rates. And if we have any kind of resolution on any tariff deals, that will be positive. So this has been same since April, to be frank. I've been talking about this. So you can keep watching on those as a triggers. And any negative news can be the bond yields rising. Any negative, like what happened today was we had a great NVDA earnings, which was market was going fine. PC number was great. So we had very good news in the morning, and then the Trump tweeted, and that took the air out of the market because people are again got worried about US-China trade. So this is what is happening right now, push and pull, I would say. So tariff news can be positive or negative. Tax bill news can be positive or negative. And then we have individual stocks are always in the news. The good news is that AI spending, AI earnings have been great. So the tech market, which I believe 80 to 90% of investors here are heavily invested in tech. So we can talk about that, right? Means the main thing there is that we have a pretty good AI spending. And I don't see, the good news is that this world is very different from 2001 or 2008. We have this mega powerhouses like Amazon, Google, Apple, NVIDIA, who don't care. I mean, they're not borrowing money. They don't care about high interest rates. They are sitting on cash. They have existing businesses which are generating cash. So they don't borrow money. Um, so that is why the AI spending is not impacted. In the old world, when most of these things, most of the tech development used to be done on borrowed money, this would have killed the whole AI wave, this whole macro environment. Today we have like crazy amount of cash with these companies. So also we have huge amount of private equity which is willing to invest in AI. We have so much money sitting idle because of this situation. So, and as all the analysts are talking about that, because money supply is going to go up, your inflation will be up. So there is a need to beat the market even higher. So they are willing to take the risk even more. So this is the I kind of disconnect where I would say top 1%ers or the money people will keep going towards how to grow that money further using tech. And that is one thing which we can watch out as investors of how to go and pick those trends and stay on that side of the bucket rather than old kind of economy. And I think before we started recording and a few people came in, so somebody asked about oil, and I said, this is exactly where nobody cares about it. The big money investors, these are the old markets, so don't get stuck in those. Like, don't get into oil markets or even gold is, I think, at some point, because we are means if you know me and if you're following the stuff we are doing, we were not huge on gold. We always knew that gold will be an inflation hedge, and especially we doubled down only because last year we started this huge breakout of gold price. But my belief is all these are old economy things. We are seeing Bitcoin becoming the new gold. We are seeing semiconductor becoming the new oil. We are seeing a lot of other things which are happening, which we can go into. All right, so let's take a few more quick questions. Usually we have, so again, just a quick, a few announcements. We usually do this call 4 to 5 if you're new. Today was an exception. We will try to do it at 4 to 5 p.m. This is a regular same Zoom link. Second thing is that we are having a great options workshop pickup, like we did like in our investor day, we did that, and the community wanted to continue that because we could not cover all the material. So we are doing it on Sunday. So do reach out to the admins if you have you want to join that. And other thing is, I would say we are pretty excited about overall the learning together right now. The community is getting into more next level, like which we really love. So feel free to tell us what you want to discuss. Quick questions on the comments. Let me take a few. So any good stocks you recommend? So again, this is the macro call. We are not going to go into stock recommendations. We do have our all access newsletter, so you can join that, which has recommendations, and we explain the reasoning and so on. So I would skip this question. And there's a question about the online nature of the workshop. Yes, I think we did it last time. There were some hiccups. The only challenge I face every time we try to do these workshops online, we try to record it for sure. We have mostly managed to record them. Whenever we do online, unfortunately, because I have remote admins and so on, there is always a coordination issue with Zoom links not going through or something bad happening on that day. So I won't promise it, but definitely we do Zoom. We make the link available. We do recordings because we do understand that not everybody can make it. So do reach out to admins for that. But personally, I'm just going to be careful here. If you can make it in person, because also because when we are doing workshop mode, we will do a lot of whiteboarding. That was the intention even the last time, because there's a lot of I'm not here to tell you the basics about options, right? Those you can find online, and nowadays mean, there's enough documentation, YouTube videos, or you can even ask ChatGPT. I think the goal here is to learn from trades, learn from trade examples. And the main thing about trading is not about identifying the best trade. Like I think most of us know what are the best trades, right? I mean, most of us know if you had owned Apple forever, last 10, 15 years, you would have made money. If you had owned NVDA in last 4 years, you would have made money. Like these are very obvious things. Options is the same way. Like the tricks are all there in public. It's more about how do you build your portfolio? How do you use that knowledge to like making one trade and making like, $10,000 trade and you made a very quick 20%, you made $2,000. Did it move the needle for your portfolio? If you have $1 million portfolio, are you able to beat the market at a 20% rate year after year rather than one trade where you made 20%? That's what we talk about. That's what our goal is to teach. And this is what I have done. Like, we have done expertise at our Proflex team is becoming, we have launched managed portfolio services. We do these things where we talk about how to do allocations, how to do your, how to get returns. So that is the goal here. And those things are very difficult in a remote environment because there are so many nuances to discuss. And that's why we are trying to do these in-person events as much as possible. But again, as I said, if you are finding value from recordings, go ahead and you can reach out. We will do that. I see another question. Which stocks are Magnificent Seven? I think you can search it on Google. This is pretty much, everybody knows it. If you're in investing world, these are the standard top 7 tech stocks. Yeah, I think we have covered most of the questions. So again, thanks for joining. I think we will try to do it more often, but I think we had a lot of workshops going on in parallel, so we could not do it every week. So please feel free to discuss in WhatsApp. I think you can always, you don't have to wait for this call. We can always have a good discussion on any kind of macro topics there. And hope people who are able to join in the workshop, see you there on Sunday. Have a great weekend and talk to you next week.